you wish to invest and to get rich. Sounds great, right? However, when you open your investment application, it is all red. Your portfolio is down, minus signs everywhere. And each time you check again, it seems to be only worse. Simultaneously, the news is frightening and loud. They are covering market crashes, economic downturns, and recessions in their headlines. Everyone seems worried. Some are panic selling. The rest are instructing you to buy the dip. And some do not tell you not to sell it all and not to go into the market. It is natural that one gets confused and overwhelmed at this stage. But then, what do you really do? One more thing worth knowing before making any emotional decisions is that a lot of the largest market crashes in history have made new millionaires. The same crashes that cleared the frightened investors, yes, turned out to be the once-in-a-lifetime chances to those who knew what was going on. The video will make you know the reason why stock markets crash in the first place, normal or fear market crash, the various kinds of market recessions, and above all, how certain investors accumulate huge fortunes in crashes and others go broke. We can create an analysis step by step. Section 1. Why do stock markets crash? A crash in the stock market occurs when the stock market declines abruptly and drastically, and numerous stocks lose a significant part of their value within a relatively brief time. Although crashes may appear to be some form of randomness and disorder, they tend to occur due to a few obvious reasons. Stock market crashes occurred mainly due to the following three factors: bubble bursts, poor economy, and some policies. Black swan events. We will briefly examine each of those. 1. Bubble bursts. When hype beats reality, most people have likely heard of so-called market bubbles, but what are they? The bubble is created when the stock prices are inflated beyond a reasonable value. This does not occur since businesses are becoming very rich. It is due to hype, excitement, and speculation. Investors begin to buy simply because the prices are on the rise and not because the companies are so valuable. Soon, the truth takes its course. As soon as investors understand that these companies cannot make corresponding amounts of money to be worth their high prices, fear supplants excitement. Humans are in a hurry to sell it, and the bubble has burst. Prices fall fast and hard. One of the most typical examples of this would be the dot-com bubble of the late 1990s and early 2000s. The internet was fresh and thrilling by then. The investors had invested in any company whose name had com in its name, despite the company not having any profits and no actual business model. During its peak, there were over 400 internet companies that were publicly traded. The Nasdaq index, which heavily depends on the technology stocks, was up by more than 800%. However, panic selling started when investors found out that most of these firms were not profitable as they appeared to be. The result? The Nasdaq plummeted almost 80% and lost trillions of dollars in market value. The index has had to wait approximately 15 years to return to the level before the bubble. That is the effect of bubbles. The hype is a force that drives prices high, and the reality is the force that kills the bubbles. 2. Unhealthy economy and specific policies. A weak economy is another significant cause of the crash of markets. Inflation becomes high, and as such, common commodities such as food, rent, and fuel become costly. Due to this, individuals spend less money. Businesses receive low profit and make fewer sales when consumers reduce their spending. Reduced profits translate to reduced expectations for the future. The response of investors is to sell, and this further drops the prices. When this cycle persists, it may result in a recession in which the whole economy may be slowed down. The crashes in the stock market are normally associated with recessions due to the spread of fear. The manufacturing becomes inefficient, firms fire their employees, and investors scramble to secure their funds. The role of interest rates, central bank and government policies are also significant, particularly interest rates. The central banks increase interest rates when inflation becomes too high in order to slow the economy. The increases in interest rates increase the cost of loans to businesses and consumers. Companies find it difficult to expand, individuals save rather than spend, and the economy becomes sluggish. This is the reason why investors are so concerned with interest rate announcements. Stock prices tend to be on a downward trend when interest rates are on the increase. interest rates are decreased, and this reduces the cost of borrowing, leading to the growth of businesses, and the stock prices tend to increase. That is the reason markets are highly responsive whenever central banks decide on the policies. 3. Black swan events. The surprising surprises. A black swan event is the third and biggest cause of market crashes. A black swan event is a sudden disaster that no one anticipates, like wars, pandemics, terrorist attacks, major financial scandals. Such occurrences bring fear and panic. The investors are not aware of what will occur next, and hence most of the investors sell their stocks as quickly as possible, which leads to the plummeting of the prices. The most applicable case is the 2020 crash of COVID-19. Few people foresaw a worldwide pandemic. In a few weeks, the world stock markets dropped over 30%, with investors horror-stricken at the thought of businesses closing their doors and the global economy crashing. Section 2. Do stock market crashes succeed? The simple response is yes. Stock market crashes are normal. Stocks do not straighten to the upwards direction. It is cyclic, and thus there are highs and lows. In case you are investing long-term, you need to realize that bad times will come. As a matter of fact, if stocks solely increased, there would be no trading at all. It is on these highs and lows that traders depend to purchase low and sell high. Types of market downturns. It is not that all that goes down the market is a crash. The market declines have varying levels, and each one occurs at different frequencies. Pullbacks, 5 to 10%, they occur nearly once a year and are viewed as absolutely normal. Corrections, 10 to 20, corrections take place when stock prices have gone down to more sensible values after being overpriced. Most often they are every 1 to 2 years. Bear markets, 20 to 40. Bear markets normally take place after every 5 to 6 years, and most of them are brought about by economic downturn or an increase in interest rates. Crashes, 40% or more, these are uncommon and tend to occur once in every 10 to 20 years, and on most occasions the occurrence is occasioned by black swan events or significant financial crises. What history teaches, US history, has also demonstrated clearly that markets do not die just after crashing, but they usually come back even stronger. In 1973, the oil embargo resulted in markets dropping by approximately 50%, and the market took approximately 7 to 10 years to recover. Black Monday, 1987, had a downward decline of 22% in one day, yet it regained the market in 2 years. In 2008, the financial crisis dropped the S&P 500 by approximately 50%, but it was regained in approximately 4 years. The market was down 30% within 5 weeks in 2020, and by only 4 months into the year it was fully recovered. The pattern here is different crashes, followed by a recovery of the market. So who loses money? Those who panic and sell. And who makes money? These are people who remain calm and have good investments. When should you actually worry? The majority of the crashes are normal, provided that businesses have not been shut down. People can still spend money. The governments and central banks take measures to stabilize the economy. It is only a matter of serious concern when the whole system collapses, banks collapse, individuals are unable to get their money, or a nation fails to pay its debt. Such cases are very uncommon, particularly in the large and stable economies. The third section, how to make a fortune when a stock market crashes. The market crash is the last thing that one wants to invest in. To the smart investors, however, it may be one of the best opportunities for wealth building in the long run. Just as Warren Buffett noted, be greedy when others are fearful. We will discuss the typical investor crash errors and what constitutes the best alternative. 1. Panic selling. When the portfolios get red, most people offload everything in panic. But here is the fact. You do not lose money till you sell. When you have good and lucrative businesses, short-term decreases cannot alter the long-term worth of the business. Panic selling seals the losses and denies you an opportunity to enjoy the gains of recovery. 2. Trying to time the bottom. Every investor attempts to wait for the perfect time when she can purchase at the lowest price. The thing is that nobody knows when the bottom is. Dollar cost averaging, DCA, or investing a fixed amount regularly is a better strategy. In this manner, you will buy more shares when they are low and fewer when they are high, but not worry about the timing. 3. Purchasing bad stock merely because it is cheap. Cheap stocks are not always good investments. Some companies do not recover. That is why it is worth considering quality companies, which are ones with good earnings, low debt, good business models, and have experience of passing through hard times. One of such instances is Amazon during the 2008 financial crisis. Amazon was trading at circa 90 before the crash. It fell to less than $40 in the crash. Those who had faith in the business and purchased when the market crashed made colossal investments in the subsequent years. 4. Lack of diversification. Investing all your funds in a single stock or industry is not safe. The different industries have different performances during the crash. Intelligent investors work on diversification in areas such as technology, health, consumer goods, and utilities. Others also invest in an ETF or an index fund, which automatically distributes risk to numerous companies. 5. FOMO and blind following. The fear of missing out makes individuals be blind followers. When everybody is selling, they sell. They believe the news in case it predicts doom. Legendary investors also acknowledge that nobody is able to have a perfect forecast of the market. That is why it is valuable to research on your own and know what you are putting your money in. Short selling, an advanced risky strategy. Short selling is used to trade at a loss by some professional investors to make a profit. Although it may be profitable, it is very risky and not advisable for beginners. Lastly, we will say that you should not be afraid of crashes. You should be prepared for them. A crash in the stock market is a frightening experience, and it is just a cycle of the market. Traditionally, markets have never missed and always recovered over time to reach new heights. Crash survival and profitability depend on how calmly the individual is, whether it is through panic selling or rather proper research and quality investments. Panic sellers lose. Intelligent investors make crashes their greatest advantage. Then, when the market crash comes the second time around, you do not fear it, but prepare. If you found this video useful, don't forget to like, subscribe, and share with your friends and family. Thanks for watching the video. See you in the next one.